The strike includes about 13,000 auto workers. Many more jobs, though, could be on the line as a result. There are 146,000 total union workers who could be affected, but the suppliers will also be under pressure. The American Automotive Policy Council estimates each automaker assembly plant job supports about 7 other supplier jobs. That's almost 900,000 workers. Our next guest is keeping an eye on that and facing the biggest impact, including Dana, Magna, and Lear. Joining us this morning, Barclays U.S. Autos and Mobility Analyst Dan Levy. Dan, thanks for the time this morning. I guess on the big three and those shares, were they primed for today's news?
Hi, thank you, Carl and Sarah, for hosting me. Yes, you know, I would say in the last month, what we've seen is a steady rise in the rhetoric and the tension. People that have been in the auto sector have known that there was this type of setup potentially, but really in the last month, this entered the broader public, and this is what we're seeing stocks that are sort of holding in. They've been beaten up in the last month already, so this was already somewhat being priced in.
So what happens from here? What's priced in as far as how long it'll last, how widespread it might get?
Yeah, I would say the feedback that we get from investors is, look, it remains to be seen how long this strike will last. But generally, the feedback we get is that this will ultimately be a transitory impact. The units that are lost will eventually be rebuilt. But really, the key question is the amount of cost that the automakers are going to take on as a result of the new contract. That's really what people are looking at. Generally, for Ford and GM, people are looking at, call it at least a couple $2 billion of incremental costs. Just for context, Ford this year is going to do $11 to $12 billion of pre-tax profit. GM is going to be something in the $13 to $14 billion range. And so people are generally looking at it in terms of the amount of incremental cost that will be absorbed annually.
Right. And I'm not asking you to mediate here, but I am curious to know where you think the point of maximum pain would be, at least on wages. Would 40 over the term of the contract be crippling?
We don't think it'll go that high. We think a more realistic scenario is that we end up at 25 to 30%. It's hard to say where this ultimately goes because there's various negotiation points. What we've published in the past is that something in the 25% range would be similar to other labor negotiations that we've seen. And that's the basis for roughly $2 billion of at least incremental cost that's being absorbed. But again, hard to say. This is in the context of multiple negotiation points in terms of inflation adjustments, in terms of product allocations, et cetera. But wages are likely to be higher than what's being offered by the OEMs right now. At least this is what we're assuming in our research.
I was going to say, so how have you changed already the models for margins and profitability?
Yeah, we're assuming some of these costs in our numbers already. We assume that if it's just a couple $2 billion, that there are offsets. GM, recall earlier this year, has talked about a couple $2 billion of cost saves that they've generated. We assume that part of this is a proactive measure to address some of the higher labor costs they're going to be taking on. Anything more than that would be an incremental headwind to our numbers.